So we dragged in Richard Saperstein, that's been doing this since OPCO time ago. And it's, it's managing money. We really don't do this much, but we're making an exception with Treasury Partners, Richard Saperstein. I got to do an audible right at the top. What do you tell on high net worth about Bitcoin?
We really don't get involved with Bitcoin or cryptocurrencies. We're really focused on core investing in stocks and bonds.
You sound like your general counsel. Okay, fine. You've been doing this since time began.
Yeah.
What is your observation on a thing that Gensler put out there with SEC that does not have an underlying value?
It's really hard to compute how we can put it into an investment portfolio and model it and get anything out of it. So we're focused on growing capital. Return on capital is less important than the return of capital.
Right.
So with that in mind, the volatility of a crypto and valuing a crypto is just not something we're doing.
Right now, they come in, maybe they own a lot of Mag 7, whatever, high net worth family, the kids are squabbling, the grandparents, there's a divorce somewhere in that. You're shaking your head.
There's always something in my world.
In your world, it's nuts, and there's always people. The will's bad, the trust is bad, and that. What's the biggest mistake high net worth makes?
They're underinvested in large cap tech. They have forgotten the value of municipal bonds. Because remember, we had a 15-year period with a zero interest rate environment. So now rates went from ankle deep to knee deep, and you actually have yield in the municipal bond market. So investors can earn 4%.
You're talking the Sweeney gospel here.
Well, big municipal holder.
Okay, so you can get 4% tax-free in a municipal bond. If you have a targeted return for a client's portfolio of 7%, you can lay down a foundation of 4% tax-free with 40, 50% of the assets. What amount of risk do you have to take on the incremental capital to drive a 7% total return over long periods of time? So that's another thing that's been missing from most clients.
And what I've been surprised talking to a lot of advisors is the demand from their clients for alternatives. I guess private credit, private equity, hedge funds. How do you think about alternatives for your clients?
We're exceptionally underweight versus, quote, the street.
Okay.
They're illiquid, they're not very transparent, and they're very costly. And when you're in an environment where tax rates are only going up, eventually, they're very tax inefficient. So from our perspective, there are other alternative investments, not alternatives, but in stocks and bonds where you can grow capital and manage your risk more appropriately.
So what is are you in the 60-40 kind of camp? How do you think about that for your clients?
It varies based on client risk tolerance. And again, what is our objective for the long-term rate of return? If we want to have drive an 8%, 9% long-term return, we'll have more equity. Otherwise, we'll have more bonds. Depends on clients' risk tolerance and how much vol they want in the portfolio.
Years ago, you were at OPCO. You were probably having Sanka with Myron Picot. I mean, this goes way, way back. I had a physician or surgeon, I can't remember at the time, say, look, all I want is 20% a year. Somebody walks in, high net worth, and they're an equity pig. They just want to make mid-double digit. How do you treat them in high net worth land? Well, you can't tell them 7%.
No, but that's not really an appropriate client for us. And so if you look back 50 years, the average 3-year return of the S&P is 29%. So let's call it 10% a year over the last 50 years. So how is that person going to get 20% a year? Well, they're going to have to leverage up a 10% return asset. Okay? And that's just not something we're going to do. It's not a suitable client for us.
All right. Let's just talk about just macro stuff. 2 weeks ago today, we woke up with a new president. We now have a decidedly Republican Congress. Did that change your outlook for the discussions you have with your clients?
Not really. I mean, it reduced the uncertainty, but created more uncertainty in many ways. So Trump 2.0 cannot be like Trump 1.0. 10-year Treasury is 200 basis points higher from 245 to 445. The fiscal deficit is 1.9 trillion. The interest on the debt is 1.2 trillion. And the stock market is selling at 22 times earnings. So there's not a lot of running room for flexibility that the markets are going to give him. That being said, certain policies will be pro Stock market, certain may not be. So tariffs, they're inflationary, they might impact earnings.
Right.
So it's very hard to say right now, but we're sticking with our core portfolios and haven't changed anything with the new administration.
You have pushed, again, since OPCO, ancient history, against what now is called wealth management. There's an entire marketed structure out there. We interview people from wealth management each and every day. Compare and contrast what Treasury Partners is doing versus the wealth management industry.
Well, we're trying to provide a 360-degree view of the client's wealth. That includes whether it's the investment planning, the retirement planning, the trust and estates, their charitable giving, and incorporate it all under one roof. And try to have a plan that moves them forward in each of those different segments. Now, all clients aren't going to be appropriate for all of that. Some clients are younger and want to grow their portfolio. Some clients are older and want to make sure they have proper asset estate planning set up. So the wealth planning, the wealth management business as a business has changed for us over the last 40 years.
But we've got this big wealth transfer that I keep reading about from the boomers to the next generations, and like it's dollars that we've never even seen before. Is that primarily an estate planning taxation exercise as opposed to what do I own today?
It's a combination of making sure clients who have over 27 million are set up with slats for tax-free transfer.
What's a slat?
A spousal lifetime asset trust where
Wow.
they can basically take advantage of their lifetime exemptions. It's very important to do that. It is supposed to expire January 1, 26. It probably won't now with the new administration. But to answer your original question, estate planning today is about knowing what you own and setting up to reduce your
Right.
death taxes going forward.
Is everyone moving to Florida?
I don't know. Ask Ron DeSantis. But I think there's definitely a migration within America from various states to Texas and Florida, and you see that in the fiscal constraints of municipal bond issuers around the country.
Are you buying national bonds, ignoring triple tax-free, fourple tax-free, or is there really a value, say, in New York State or wherever, California, of the tax advantage?
Clients in a high tax state, we try to position roughly 60 to 70% within the state. We want to have the balance outside the state in case there's a seminal tail risk event. In California, what if there's a major earthquake? What if there's a major attack somewhere? So we want to diversify out of the state to some extent. And in many cases, sometimes you can go outside the high tax state and find a bond with a higher after-tax return outside their state.
Richard, thank you so much. Richard Saperstein with us. To say he's with Treasury Partners barely describes how he helped invent the high net worth business. Part of our planning into the end of the year and into 2025. I didn't ask him what his minimum was. You know, I'm looking like, you
Exactly. We'll keep working.
$42,000
We'll
bucks
keep
or
working.
whatever. And I got 10 shares of Apple or triple. He said he doesn't like the triple leveraged all cash.
No?
No.
Not okay.
He says he's not going to, he's not going that path.